Here in Europe, Switzerland's biggest bank, UBS, is in talks to take over its embattled rival, Credit Suisse. Now, these negotiations come amid fears an ongoing banking crisis could destabilize the global financial system. Switzerland is preparing emergency measures to fast-track the takeover. UBS is reportedly asking the state for $6 billion to cover the cost of purchasing Credit Suisse, which was founded in 1856. Now, the turmoil was unleashed by the collapse of two banks in the United States. Well, Stephen Beardsley from DW Business is here to break this all down for me. Hey, Stephen. Now, media reports say UBS has offered to buy Credit Suisse for up to $1 billion. What's the likelihood of a deal today, and would this help calm markets tomorrow?
It's hard to know what the likelihood of a deal is today without being inside the negotiations or very, very close to them. We know that the Swiss government is likely to want a deal today. However, it's probably going to be putting pressure on regulators and on UBS to make this deal happen. And that's because it doesn't want an uncertain situation to be there as markets reopen again. And the preferred method to unwind these kind of situations is for a takeover from another bank. Otherwise, the regulators would have to step in and take over the bank themselves. It creates a much more clear picture when that's the case, and that's what they want come Monday when markets are reopened. You know, in terms of what it means for markets, it's really hard to say because there is such a psychological aspect to what we've seen going on. Credit Suisse has better fundamentals than SVB, than Signature Bank. It did make some of the mistakes. At the same time, it has been a poorly performing bank for several years now. It's been in a lot of legal trouble, things like that. So we knew that in some ways it had been scrutinized more and more. Depositors were leaving for different reasons, and that's why it ended up being in the crosshairs here. So on the one hand, it's great that we see regulators, that we see governments moving quickly here. They obviously have learned their lessons somewhat from 2008. On the other hand, we don't really know how this is going to go further.
OK, Stephen, UBS wants help from the Swiss government for a possible takeover. Do you know what's being discussed here?
From what we understand from those who are close to the negotiations, UBS has offered $1 billion for the takeover. It would be an all-share deal, and what it means is that basically shareholders would take a significant haircut here. $1 billion means about 27 cents a share. The business closed out, or the shares closed at about $1.70 on Friday, so you can see the kind of losses that shareholders would take. They want that $6 billion in guarantees because there are a lot of open questions around the business. I mentioned the legal troubles that Credit Suisse has been in. There's a lot of money potentially outstanding there if there are legal judgments against them, if there are regulatory fines coming against them. And because the Swiss government wants this deal to go forward, because they have their foot on the gas pedal here, it's likely that UBS will get a better deal than not. But there probably will also be pushback from Credit Suisse on the terms of this deal. So we don't know a whole lot. We just know that UBS is pushing hard for a deal that's obviously very much in its favor.
Stephen, how likely is a new financial crisis like 2008, a year that you mentioned earlier, burnt into our memories?
It's something that no one can really say, but obviously when we look at the actions of regulators, when we look at the actions of depositors here, we see a lot of fears that are built around 2008. We know that in 2008, the system really collapsed based on some products that were untenable, these kinds of assets that in the end weren't really there. That was these mortgage-backed securities where they couldn't actually be fulfilled at the end of the day. These mortgages couldn't be fulfilled, and they had an entire edifice, an entire structure of other loans and assets that were built off of them. Once that bottom got kicked out, then an entire system collapsed there. We've seen that there isn't as much leveraged on these assets today, and these assets are fundamentally good. They tend to be treasury bills. They tend to be government debt. It's just that because interest rates have been raised so fast, their value has dipped somewhat. The ultimate question here is about depositors, though. It's such a psychological aspect, as I mentioned. You have to only fear that there's a bank run to want to go to a bank and take your money out. You don't have to believe that there is a fundamental problem with the bank. You just have to believe that others will believe that there is. So it's a self-fulfilling prophecy, and stopping that is going to be the real question here. And that's something that I think we're going to see develop in the coming weeks. What's the best way to do that?
Stephen Beardsley from DW Business, thanks so much for breaking that down for us.